Happy Friday, everybody. I'm your host, Shad Daleson. Thanks for checking into our latest Traded Black podcast. Good show here today. Jim Cacioppo, the CEO of Jushi, is going to join us in just a moment, followed by our good friend Anthony Coniglio from NewLake Capital. Both companies reported the latest earnings and some great turnaround stories. NewLake continues to provide a lot of value for a lot of its shareholders, doing, let's face it, some volatile times for this industry. And a good turnaround report by Jushi. I know a lot of people know this company, but they've kept their story, I think their cards pretty close to them over the past year or so. So we want to learn a little bit more on these latest earnings. We're actually going to have a second part of an interview next week with Jim that talks about some of their growth states, which include Virginia, Pennsylvania, and Ohio, a company to watch for. So with that, let's welcome in here on a Friday morning. AV, good to see you. I was told behind the scenes to have more energy off the top, so hopefully I got a little bit of energy right there.
Yeah, that was a good intro. It's Friday. I know we're end of a busy week with earnings, and looking forward to getting into this.
I know. Lots going on, that's for sure. Lots of numbers. Got to keep up. But with that, let's welcome back to the podcast. It's been about 6 months, but let's bring up Jim Cacioppo from Jushi, CEO. How are you, sir? Good to see you on a Friday morning.
Great. Thanks, Chad. Great to see you and AV.
Yeah. And
thanks for having me.
I said off the top, and as our story basically title here is this a good turnaround story? But, the latest numbers, you showed significant strides in reducing your net loss, moving from $65.1 million in loss in 2023 to $48.8 million in 2024, which, as doing the math, is nearly $16.3 million improvement. So walk us through, what were the key drivers behind this improvement in financial performance?
Yeah. I mean, I would frame it this way, just to change the framing of the improvement, because I look at cash flow from operations, which, by the way, is in our GAAP reports. There's three, just for your audience, there's an income statement, there's a balance sheet, and there's a cash flow report. First, there's three sections of the cash flow report. First is cash flow from operations, then there's cash flow from investing, that's CapEx and acquisitions or divestitures, and then you have debt pay down or debt, So we generated. So I'm going to just frame it in a more positive way as opposed to talk about losses. In 2023, we had a negative outflow. We had an outflow of cash flow from operations from that GAAP report, right? The top section of I think it was 3 million, 3.5 maybe.
Okay.
And I think it was 3. And then this year we did 21.7 million. So last year, 24, we did $21.7 million of cash flow from operations from our GAAP reports, right? And 7.2 of that was in the fourth quarter, which was a record amount of cash flow from operations, right? So the turnaround was based upon us starting to cut costs in 22 in retail, and then turning around the grower processors later in 22 and mostly in 23, and cutting costs the whole time, right? Getting more efficient. So that's a big part. Also bringing up our yields in our grows, and also bringing up our quality in our grows, which both are still an ongoing process in some plants, but some plants have really achieved industry standard for high quality, high yields. So we still have some more to go, and we're always focused on costs and efficiencies, and that will continue. And we're in good states. Virginia grows. Virginia's a grower. It's a cash cow. We have great stores in Illinois. We got hit early because we had the Missouri border, but then we got through that. We have solid, good stores in Illinois, and Pennsylvania. 18 stores and a big grower processor. We're a big company there.
Yeah.
As far as meeting the consumer, as far as meeting the demands of the consumer, and I guess creating those operational efficiencies, you did report that I think you had 415 SKUs that were put into market across the 5 vertical operations within the portfolio. Walk me through that. Like, are you meeting the consumer with what they want? Is this sort of putting product in, using a data-driven approach, and then rationalizing those SKUs? What's the strategy there?
Yeah. So the consumer, in our view, it is data-driven. We have a tremendous data system coming through retail, where we understand what the customer wants. We sell about 55% of our own products in our stores, which means the other 45% are third party. That's actually a pretty big ratio. Consumers like the fact Jushi doesn't just push their own product like others might. There's one company or two companies that's really what they do, and then the others just come off that by a little bit, right? And so we have a lot of data on all these products, and we're very good at that and very focused. We're numbers people at the top of the business, right? So but in our view, the consumer likes new genetics. They like new formulations, and so a lot of that is new genetics and new formulations. It's a new SKU. You haven't had it before, right? And we constantly refreshing our genetics. Every year we refresh our genetics, and we get rid of some. We put it in cold storage, or we get rid of it, means that we kill it off. It doesn't exist. And so that's the biggest piece of it. And the other big piece is adding formulations and SKUs, both in the vape and the gummy category, where we bring in different terpenes, different effects, and one that might make you more relaxed. And then we have a kitchen sink one where we put all the terpenes in, and CBD and everything. We don't call it kitchen sink. That's an internal thing. But we're constantly and now going forward, a big move is in solventless. We're kind of got at efficient. We're at the point where our solventless is competitive price wise, or cost wise, not a little higher. And there's a lot of margin in that product. So we think there's a lot of growth to go there. And that's early for us in most of our states. We just got to the point where we have the right genetics to get the wash rate, to get that's moving forward, right? And we're putting hydrocarbon. We're putting hydrocarbon for the first time in Virginia. We don't have that, and then of course Ohio, we're adding a ton of SKUs.
So how is Ohio? Are you seeing stabilization in prices? And I mean, is it starting to bear fruit on what I guess we were expecting coming out of Ohio? Are you guys seeing anything in the numbers? Coming out of Ohio?
No, we do. So from a Jushi perspective, so just give you history for Jushi and our perspective, we had a small grower processor that we picked up in a forced sale, one of the big companies bought another big company, and then forced sale, and we got it what we thought was a good deal. Owned real estate, no lease. We're mostly owned real estate, no lease or short-term leases, not this, that's the other thing. We're not, burdened with this IPR style debt. We have just one small piece of it, right? And then we have a small processor as well. And then we had one store, kick-ass store in Cincinnati, amazing location, did really well on the flip. It was up over 2 times like day one. Some people didn't get that. And then we started, doing our retail strategy of opening new stores, right? Yeah. And we've been what we're good at and what we like to do is buy paper, not cash flow, and not revenue. So some of those who like to buy revenues thinks it's expensive. For those of us who, and there's not many people who can really do this because it's really hard work, is we buy paper, and then we also have to find the real estate often. It doesn't come, or you have to just open it. And it's just a whole different game. And so that's one of the things we've been able to get good value. So in building a business, we love it. And then the other thing, I think some of the folks you talk to built up their excess GP capacity to serve what they thought was a 2x with the tough regulations there. It's going to be 2, 3x, 3, 4x they were talking. But they invested, and for them, they had this, they got it wrong. It went slower in Ohio. For us, we may have got it wrong too if we had the kind of capital to build that. Maybe we would have been wrong too. But we haven't had the capital to just go out and throw it and grow a processor. So in any event, what we're very happy about is there is a wholesale market. We're worried that we couldn't get third-party product in our stores. We can. It's great. Okay. And we can buy it at prices. We can make money. And we're also buying bulk that we package, which is even cheaper, put in our packaging and make money. So we're in pretty good shape.
Good. Well, I was going to ask you about how wholesale and what you think, how things are going to change or at least develop here in 2025. Your gross profit margin improved to 45.9% compared to 43.1% in 2023, showing better operational efficiency. Q4 saw a slight dip. So what are you seeing right now on the wholesale level that people should be, taking note of?
Yeah, the dip for us was self-inflicted wound. Quite frankly, it's there's always a little more promotion in the fourth quarter because of the holiday season. 12 days of Christmas, and you have fun with that, and you drive sales. But for us, we had some packaging issues primarily because of some equipment downtime. Big time in Pennsylvania and Massachusetts, a little bit in the other states. And what this had to do with was primarily is we had a vendor go out of business Earlier in the year, our management team was a little late to figure that out, that they had to start like figuring out how to get another second source of parts. And so those were for our vape machines. The vendor was called IES. And now they put up shop, like some people used to work there, and they're providing us, compliant parts. And I think we could have done a better job of that. That's the self-inflicted wound, to be quite honest. And I got involved and started, yelling at people and saying, "What the fuck?" Like we could have done this months ago. What are you doing?
Right.
And then the other one is this key part of it. And we just needed more equipment. Okay. I think we designed less of it than we needed, so we didn't have redundancy. It would go down, and we fixed that. In Pennsylvania, we added another one of these machines in February, and we're in the process. And really, that was where that issue was, So in Pennsylvania, so we're beyond that. So let me just do the math for you, okay, if you don't mind.
Yeah,
so
go ahead.
I'm making the numbers up so people can simplify it, okay? So if you're when you're producing products, right? If your packaged goods, your ability to get into the package gets cut in half, you only do 50% of it, right? Of what you were doing, right? You still have the same lease, right? That hasn't changed. You haven't fired people because it's just a temporary thing. You might be even hiring people because you're growing, and then you have the same electricity costs. Those are the big three, and so nothing really changes. Right. Okay. So that means your cost per unit is double of what it was. And that got on our balance sheet in the third and early part of the fourth quarter. We've worked through most of that. So that it was a cost per unit issue for us that we've worked through.
You had also mentioned that you wanted to aggressively grow the retail footprint, I think by as much as 40% potentially in 2025. Are there any markets specifically that you're looking to fortify within the portfolio, and or are there any markets that you're looking to add on in regards to the current existing 5 that you're in?
Yeah, absolutely. So I would point out, if people look at the press release and the transcripts, you'll see that we've identified publicly 10 locations that are online by the end of this year. 5 of which are already open. Okay. And the other, there's 3 more being put in place by the end of the third quarter, 1 in the second quarter, and then 2 in the third quarter. So we got a glide path to 8, and then we have 2 more in the fourth quarter, right? The further out there, there's more likely that they slip, right? Because you have less, you're less close. But the other ones are pretty good in the second and certainly in the third. So we're, of the 14, we're at 10. And by the way, the math of that is we started with 35. So 7 and 7, I like those numbers because 7 over 35 is easy math, 20% increase. We said we'd do that by the middle of the year. Well, we're not getting 7. We'll get 6. Well, we get 8 by the third quarter. So I have to break even as far as I'm concerned. And then we do 7 more, which is another 20%, which gets you to, 40%. People are very skeptical of that part, in their analytical reports of us. We're already at, showing path to 10. So I feel like we're on schedule. Those other 4 we're identifying. And AV, to answer your question about locations, number 1 is building Ohio existing market. But we were small. And so we're going from 1 to 8, and so that, and number 2 is, and that's been our biggest attitude. We opened a store in Pennsylvania, existing market. We had previously closed that store a long time ago. And then we opened a store in Illinois, an existing market, right? And then we have a new market to us, which is New Jersey, which is 2 of those. One, we mentioned Linwood, New Jersey. And by the way, these are licenses we're effectively winning and not paying for in New Jersey. So we feel like it's a mix of all, and we haven't identified 4 of the 14, and we're doing that work, and turning stuff down right and left. Hey, this doesn't meet our hurdle rate.
18 of 40 dispensaries, correct, in the state of Pennsylvania, correct?
Correct.
Yeah, I bet you're watching that closely then, as far as the adult use. But I think it's going to happen. It's just a matter of when. And I know everybody's just that's always the biggest question that people ask, which we can't answer. But it sounds like there's some promising things and some great negotiations. We'll get into that a little bit more as far as the second half of our interview with you next week. But that's a big footprint, right?
That's there's only Trulieve is 21, and there's like a few of us with 18, and then it drops down to 9 or 6 or 3. So we're one of the big people in
Yeah.
Pennsylvania.
Yeah.
Definitely.
Yeah. Well, look,
I've got
I know.
By the way, as a percentage, I mean, you pointed this out, but I just want as a percentage, 18 over now 40, that's almost 50%. I like to make numbers easy. That's almost, we're looking to open a 19 there, and we have some technology to do that. Maybe we can, maybe we can't. There's risks there, but caught 18 over 40, like it's the biggest pop. Like if you want to play that political process, we're the most bang for the buck on that by far.
I think we need to have a weekly segment called Doing Math with Jim. What do you think? But listen, I know debt and tax strategy has been a big topic of discussion during this earnings season. Look, here's an interesting angle, because I know that you managed a hedge fund with over $5.5 billion of assets at one time. So you know firsthand how big corporations structure their finances. One thing worth noting too is that a lot of blue chip companies don't have to explain their tax strategies in earnings. However, in the cannabis space, we all know tax liabilities are often scrutinized, which is much more closely. So from your perspective, as both a former hedge fund manager and now a CEO of a cannabis industry, do you think about the long-term tax liabilities for companies operating in this space, and should they be heavily scrutinized the way they are, knowing that other companies really don't have to explain those strategies in their earnings?
Yeah, I mean, first of all, you can't explain them. That's just, like nobody's comfortable with that, legally. So you can't, and it's a bad strategy, negotiating strategy. I mean, we all know about negotiating now with our new president, right? And it's on display every day, multiple times a day.
I'm sure.
So, but I would say that it's not tax debt. I saw your Anthony and Frank Colombo talking. I just saw the out clip of that, and it's not tax debt. It's something came up on my screen there. Yeah. So it's a tax dispute.
Okay.
Right. And so what we have, I thought, first of all, I also saw Kim. One of the reasons why I'm on this show is as I started like watching some of these clips, and I said, this is really quality production and really good information. So, that's a compliment. And I was like, okay, I need to get back involved here.
Appreciate that.
So I think Kim, has a lot of credibility. She's done a great job. So as an investor, I'm really happy to have Kim along as a leader. There was only two companies that did it at the same time in September of 23, TruLeaf and Jushi.
Okay.
One of the biggest, most respected, and one of the small up-and-comers, right? And so one of the things that we're very good at is numbers and deals and M&A, and I think taxes falls into that, right? Like number of people, we're very good at litigation. We do a lot of litigation, and it's a tool, it's necessary. And so when you look at tax, we were early. We have legal opinions from top law firms, and the accountants say, well, I don't know, so put it on your balance sheet, right? Like that's their job. Their job is to be the most conservative possible. And by the way, it protects us as a board and a management team to show the liability. So it's all good. It's all clean, and the investors could look at it. But what would the process of resolution be is what people should be asking, right? And you know what I'm saying? You know what I mean when I say that?
I don't, but go ahead and explain further.
Okay. All right. The process of resolution is basically what happens when they come and say, hey, there's a problem here, right? Yeah. Well, your debt falls due, and then you go, I got to pay you, right?
Right.
That's that we know how that works. And with a tax dispute, they come in and you talk about it, you educate them, they educate you, you negotiate. You try to resolve it, on a friendly basis. You have a disagreement, and then maybe you litigate, and maybe you win or lose. If you win, it's great. If you lose, I can appeal that, right? And so you have this multiple level of appeals. It takes years. So it's not debt. Like debt falls due, and so
it's a tax dispute, not tax liability.
Yes, and if you have legal opinions, it reduces. And then you talk to guy, and I don't mean to pick on people at all, but you talk to the analysts who don't really know, because how would they know about taxes? That's not their job. Their job is to look at companies. But if you have good legal opinions, and we do, and I'm sure TruLeaf does, you mitigate the risk of penalties and interest, right? So because it's not you could look at the tax code. There's different layers of disputes, and if you just kind of winging it, they or you made a mistake, penalties and interest.
So saying that, how does this happen then? With if there is rescheduling and 280E were to go away, like how does this whole break out? Because people are going to have to owe taxes at some point, are they not? But if there's tax disputes, like how does that work with the IRS?
Well, we don't know, but you can look at other companies. There's something called the double Irish, which is a very famous tax strategy that they've been going after for years. Apple's, pays like a 2% tax rate on its offshore, right? Yep. And very famous companies are in Ireland. The double Irish means they have two different companies. And I can't make heads or tails of it personally as a hedge fund guy, but I know they've been very successful in keeping that. So I think it's gone on for 20 years, and I think the IRS stopped fighting it. I don't hear about it anymore. So there's a 6 year, so from when you file your taxes, they have 6 years to come up with a dispute, right? It might be 3 years. I forget. I'll come back. Next time I come back, okay. I'll know 3 or 6 years. Trent will help me remind me about that. So, and then if they don't, it's gone away. They can't do it anymore. Right. They have to, so that's one, so that happens. And so basically, if they normalize cannabis from a Schedule 3, it seems to me that, people at the IRS are going to lose their gusto on this. It's kind of a one-time thing. It's old. It's not continuing. It seems to me we'll be in a better situation than we would otherwise be in. And there's only one company not doing it, right? So when you have comps, you can look at the comps, right? And you can look what everybody's doing. There's only one company not doing it. And if I was, investor in that company or asking questions to that company, I would ask about that 6 year thing because they only have they have to refile theirs or 3, I forget what it is. Or we could all benefit and they've paid away, So, I don't know how I feel about that as a potential shareholder. I happen to be a shareholder of that company in my hedge fund, by the way.
So as the industry gets normalized more, is it fair to say like the IRS is going to look at this in a different light, I guess, with rescheduling?
I mean, I don't see how human nature doesn't go that way. I mean, we're all human beings. We're all guessing, but I mean, it seems like I think I'd rather pursue Apple or NVIDIA, who are paying 3% than beat up on guys who are entrepreneurs in the cannabis industry. And by the way, there's precedent. There's precedent out there. And let me briefly say this. We've looked at all these California retails. We had this strategy of going to California retail only. It was the best way to play California, but it sucked anyway. Okay, it sucked anyway. Okay, so we kind of got out of that all that. Luckily, we didn't do too bad, right? Other people have done much worse. They bought big, Anyway, we diligence a ton of these things because that's what we do. And so you look at their taxes, they all were cutting deals 10, 15 years ago at 25 cents on the dollar.
Gotcha.
And then there's another comp that's a public company. It's called Statewide. It was originally Harborside. And if you look at their deal, you can their 10K, you could do all the work. They did like a 15-cent deal, right? So that's precedent. So again, I would be, I don't know. I don't think this is as controversial as the market does. And I think those guests who you had who, if they call it debt, you ought to have them back and say, hey, Jim said this. Give me a video clip and just see what they said.
Okay.
See what's the other side of that. See, that's a good, and I'm coming up with good content for you here too.
So as far as 2024 goes, how would you define 2024 as a whole for Jushi? And strategically and operationally, what's the mandate for 2025? For the business?
I personally describe 2024, as a home run.
Yeah,
but I think we needed to hit at least a triple. Stand up triple.
Yep.
We couldn't even slide into third base. So we were under pressure, and I think we did what we had to, right, and more by a little bit, right, and that's a tremendous amount of momentum. You don't just all of a sudden, you don't all of a sudden just get stupid. We were stupid in some of the things we did. The whole industry did some stupid things, but we got smart. I'm still here. I founded the company. John Barrett is the president. He was the co-founder. Trent, Trent, he's been with us 8 years. A guy named Matt Leaf, who runs compliance. Our management team's in place. if you look at these two companies that are restructuring or the amended, pretend, whatever the hell it is, there's nobody there, right? So we have our full complement of management team. We haven't had like a CEO that's come and gone, or executive chairman, or this or that. No drama, right? Now we've had operating people that we've changed out and we've learned from and we've moved on. But so we feel like we're taking that into 25. And obviously the big gain is in Pennsylvania. I am going to Pennsylvania next week with Trent, and we are talking to some people. It's not like we're watching. We are involved, and we are involved in Virginia.
So you think that best describing the company today versus the past, like as far as the executives, is it a more hands-on approach versus say the past, or am I, because you said,
I'm going to speak for John and I. First of all, we're at the top of the company, right?
Yep.
And second, we've been here since the beginning and we were founders, right? So we started this as hedge fund. He worked for me in the hedge fund. We were founders. John and I have been together for 12 years as business partners, right? And so we started it. We had other founders, but we're the ones remaining who always were planned to run the company, right? That was the deal. And so we, of course, we didn't know how to run a cannabis company, 7.5 years ago. I mean, like who the fuck did? Nobody apparently did. Used to win licenses and then figure it out. Now we were late.
Good point.
To win big licenses in Illinois and Florida, so we were buyers. So, and by the way, M&A skills, hedge fund, valuation, and we're damn good at that. Did we make a couple of mistakes? Yes, we did. After a great string, they loved us and we got cocky like everybody else did. And so we learned from that. And then we turned and said, fuck, we hired too many people. Excuse my language. You can beep it out. We hired too many people. And
we're live.
Yeah, that's right. That's right. I always watch the clip, right? And but we hired too many people. By the way, we had like some ginormous 1,650 people and less stores, and we have 1,250 people, right? And we've had people come and go.
Yeah,
we kissed a lot of frogs, but those decisions used to take me 2 years to kiss a frog and figure out it was a frog and not a princess. Then now that decision takes months. And by the way, I'm in there. I understand all the numbers. I make the decisions. I run the company. I feel like a world's expert in cannabis. And I feel like I have to forget some of the stuff I know and not be so in it. Although I'm kind of joking and being facetious because I know so much. So John's the same way. So yes, we know what we're doing now. We're not going to all of a sudden get stupid. We both went to great schools and we did great backgrounds, very blue chip, all this nonsense, but we didn't know how to run a cannabis company 7 years ago.
Yeah. Do you have $3.5 million I can borrow? Because wow, that was a pretty impressive announcement you made last week where you put in $3.5 million of your own money. So being a former hedge fund manager who understands risk and return than most, why did you make this move? Because to me, it signals that you think there's some opportunity, and that's what a lot of people still think on the horizon for the overall industry. But that was an interesting announcement you guys made last week.
Yeah. And okay, I would point out, I always add to the description. I would point out, I put $9 million into the first lien refi last July or August, whenever it was, July.
I remember that. Yeah.
And my largest shareholder, other than me, put in like $7 million, and he also put into this deal. And by the way, I have $10 million into the second lien deal and $9 million into the first lien deal, right? Okay. And our shareholders, large shareholders, I mean, people like four or five phone calls, 3, whatever it is, 5 phone calls. We control, like, I think this, I'm saying a number, but I'm saying, like, I'm not sure if this is right, like 60% of all. So our situation is much different on the debt side. So you want to know your lenders. There are some people out there that are very famous in the industry, right? Being very good at what they do. I met them and I'm like, no, I'm not dealing with these people. No. I'm not. It's kind of like I'm working for them, right? They might have worked at Goldman, they might have done this, and they're very smart, all these different things. But like, no, thank you. And so we pretty much shield ourselves from the sharks out there, and who are doing that, and we will continue to do that. We want good lenders, and so that's always been a focus. So that's one thing you always want to learn. 2, Guess who understands the debt as good as them or better? Us. Why do we do that? John was with me. It's because we restructured these things. We understand the contracts. We understand the lawyers to hire. We understand how to, you can't just let your lawyers do everything, how to manage it, how to negotiate it.
That's your strength.
We think pretty good. And the third is we have credibility with them. Like they look at us going, oh my God, these were their equals on the debt restructuring side. So that credibility is important. So I think we get, so I think we're in really good shape. Remember, we have, 48 million in the first lien, and we have about 85 million in the second lien, comes due at the end of next year. And we have like pro forma for the cash we just raised, we have like 30 million. So I feel like we have a runway to refine the down case. We're growing our dispensaries by 40% in the downside scenario where Pennsylvania, Virginia doesn't happen. I don't think we're getting credit for that growth strategy. Number one, that's why I like it. Okay. I don't think we're getting credit for anything happening in Pennsylvania. We're not getting a 25% chance. We're not getting a 10% chance in Pennsylvania. And in Virginia, we're getting zero credit for that flipping next year, which is what's going to happen. So we have zero credit on three big fundamental things. People view tax debt as versus a dispute. That's 4. I got 75% warrant coverage at 45 or 50 cents. See where the VWAP shakes out. I love the deal. Very protected on the downside, tons of upside. Jushi, our cost of capital will go down. Our cost of capital will go down so dramatically if Pennsylvania happens. And you know what that means? Cost of capital is cost of debt. All the risk goes away. And what happens when that happens? So that's why I was interested in doing 3.5 million.
Yeah, I'd be curious to know, being a former hedge fund manager, having personal relationships with people in that industry, does it help at all when it comes to buying your stock?
First of all, in the hedge fund base, which for me is where you want your lenders, is in the hedge fund space. Not all of them created equal. Some of them are these sharky ones that kind of want to just beat you up all the time to get fees, and then they ultimately want to get 30% of your company without extinguishing any debt. I never heard of a deal like that in distress. I only did distress for 25 years. I never heard of a deal where you extend for a year and a half to get 30% of the company. And I never heard of a deal where you extend for 2 years and get 20% of the company. And this is some easy math. I want to see. I bet Shad could get this. Shad, what's 20% of 0? So 20% times 0, what is that?
That's 0.
Okay. What's 25% of 0?
That's still 0.
And 30%?
0. Okay.
They're all 0. So like, I don't understand what they're doing, and I have no bid for that. And so is it the fact that I know who to go to and I know how to restructure deals and I keep my debt low? I mean, I got in a panic. I said, okay, none of this worked out. You know how much debt we paid off since July 1st of 2023? $30 million.
Yeah, it's big.
And we have a growth strategy, and we refied when nobody thought we could do it. So, like, I think we have a track record. The relationships certainly help. I mean, some of these folks got into the first lien, and I know the second lien people very well. Hopefully, they continue to support us. And on the first lien, on the conference after the earnings, we talk to them, we communicate with them, we make sure, And then I have a whole farm team of people I've been talking to who aren't into cannabis yet, who I want, to look at us when they decide, Schedule 3 happens, maybe banking and stuff like that. So absolutely 100%.
That's good. I want to learn more about that story next week when we have you on again. But listen, great job. We got to run with our next interview. But this is a great turnaround story. I know that you guys have held your cards pretty closely over the past year. I can understand why. But according to what Anthony asked you, how would you best evaluate this last year? And you look at it as a home run. It's a great story. It's a great turnaround. And, we look at some of these companies that are poised to really, outside of, let's say, the Trulies and GTIs, we really want to shed light on some of these companies that could really move in the event we get rescheduling, and reasons why we wanted to have you on to learn more about your story. But listen, next time all I ask is bring a little bit more energy and you should be all right. Okay?
By the way, I just want to point out to the audience, I wasn't the person who said Chad was low energy. I didn't say that. I did call him Little Chad.
No, he was, and it was damn all right. No, actually, Anthony was. But anyways, Jim, good to see you. Tell Trump you say hi. All right, Jim. All right, thanks.
Thanks, Jim.
Okay, bye-bye.
Yeah, appreciate it.
That's some great math with Jim. But yeah, I kind of sat back and listened. I could see you kind of nodding your head. That's a lot of stuff that you understand and get. But the way he was explaining some of that stuff, you can understand just his mentality running a hedge fund at one time. But curious to see what kind of relationships and connections that he has in the event we get reform. And like I said, how they actually think. And we all know that if one hedge fund writes a check, they always have that kind of FOMO, and it leads to other opportunities. But yeah, I think it's looks encouraging, and it's a great turnaround story for the most part, right?
Yeah, it's good. Solid earnings, solid step in the right direction. And I mean, 2025 can be transformational for them, especially if they get some momentum in PA.
Yeah.
And VA, I think VA is a 2026, 2027 story. As far as that's concerned.
All right, let's move into our next interview, and welcome back to the podcast. Great friend of the show, CEO, NewLake Capital, which trades on the OTC under the ticker symbol NLCP, and a man who said I need to have more energy this morning, and I hope I brought it, but Anthony Coniglio. Good to see you. Happy Friday.
That's right. And you brought it. You delivered. You were the postman today. You delivered. I loved the opening.
Yeah.
And you know, a good thing you did, because you needed to match Jim's energy level. That was great.
He runs fast, but yeah, good stuff to say the least. But listen, wanted to have you on too. You had your latest numbers, and despite the headwinds of the cannabis industry, you delivered strong results across all key financial metrics. You grew full year revenue by 6%, increased net income, and raised your annual dividend once again. Testament to disciplined management, I would say. So what has been, I guess, the key to maintaining, I guess, a strong performance in a difficult environment right now?
Yeah, you know, before we get into anything about NewLake, I just want to say, Anthony, to you, congratulations to you and your wife, because
thank you.
We spend so much time in this industry focusing on the industry and the business, but at the end of the day, the family is really what's most important. So, you know, so happy to hear everything went well, and really best wishes to you in your life. It's the important stuff in life, for sure.
Much appreciated.
So on to more mundane things. One correction, we didn't actually raise our dividend. I want to be clear for folks. We maintained our dividend. It wasn't a dividend raise, but we did announce it in conjunction with the quarter. So, you know, really what has been putting up this performance, what I like to say, and I think I've said it on the show, is that the performance today is really a result of the work that we did a few years ago. It's the way we underwrote those transactions. It's the deals that we selected to pursue. And I think the quality of the $50 million of revenue, the 83% of AFFO coverage, that's the percentage of our cash flow that we're paying out in our dividend. I think that shows that we have a quality platform that's creating some stability for our shareholders. And it's allowed us to grow not only revenue year over year, but our AFFO, which is our key metric, was up 10% year over year. And what we all know is a really difficult environment for the cannabis industry.
Totally.
So it's a testament to the team. The team's really done a great job in underwriting these deals, but also in being proactive in situations when things don't go as the way you want them to.
Well done. Well done.
With the foundation being built, and with the machine that you've built with NewLake, creating this stability and yielding these results year over year, you talk about how this foundation was built years ago in the underwriting process. How are you looking at the industry today, and where are you looking to maintain that growth and that disciplined capital deployment within the industry?
Yeah, cautiously is the word. And discipline. You use the word discipline. We use that word all the time. We don't want to grow for growth's sake. And lots of companies are out there trying to deliver growth year over year because they think that's what shareholders want. We're only going to focus on quality growth. It's easy to do deals, but it's hard to collect rent for 15 to 20 years. So just to remind people, our business model as a sale-leaseback provider is providing real estate capital and entering into a lease that is could be up to 20 years in duration. So we need to be confident that that transaction can deliver rent for the duration of that period. And so it's a real strong.
That's a long time though, right? Like that's a long time.
It's a very long time, but that is the business that we're in. I mean, if you look at, and by the way, let's remind everybody, sale-leaseback isn't something specific to cannabis. If you were to look at FedEx or Walgreens, Starbucks, Home Depot, businesses that all have large real estate footprints, almost all of them are utilizing sale-leaseback in some form or fashion to fund the capital needs for their real estate. And so as you apply it to this industry, you're going to continue to see this industry want to utilize that type of capital formation to support real estate build out. And so it's just part of the overall business. But what that means for us is we have to underwrite the property. We have to underwrite the tenant to feel confident for our shareholders that we can make the return profile that we expect as we go into that deal. And that means collecting rent for the duration of the lease.
Did you want to go ahead? Sorry, I was going to ask something and I thought it was interesting, but one of the most important metrics for investors in a REIT is available funds from operations, which you've indicated, which increased 7.5% year over year to 43.7 million in 2024. You outline this because it's critical because it supports dividends and future investments. So kind of like what we did last week, can you break down maybe like why it's such a key metric for your business and how you've been able to, I guess, keep it growing during these market challenges? And maybe, I don't know if there's an example that you want to highlight based off of that.
Yeah, I'll explain the AFFO, and then I want to make an amplification to make a point. So from a REIT perspective, real estate investment trust, we raise capital. We use that capital to invest in real estate and the leases, as I just explained.
Yep.
We run a really lean team. We're a small team. Our expense ratio is one of the lowest in the industry. And so when you look at the net cash flow, earning $50 million top line, $43 million of free cash flow, we're managing our expenses pretty judiciously. And so that's that AFFO, available funds from operations. Think of it as free cash flow. And then from that, it's the amount of dividends we paid out. And for the year, we were around 82% payout ratio, which means there was 18% of that was retained on our balance sheet to build the balance sheet and to make future investments. And so those are our retained earnings, if you would think of it in a normal corporate fashion. In terms of the AFFO that you quoted, you're correct that it's 7.5% on a revenue basis, but on a per share basis. So for each one of our shareholders, it was 10%. Well, why is that different? Well, we utilized our share buyback program in 2023 and towards the end of 2023, and we bought back shares at almost $13 a share on average. And that was extremely accretive. And so the point I wanted to make with that is that it's not always about doing deals where we can create value for shareholders. It's also utilizing something like our share buyback program to create very accretive value for our shareholders as well.
Well said. And I know there's been I think there's 3 key factors that you always outline. It comes to quality operators, strong markets, and locations. I do know that we've seen some stories, and I don't want to get into specific competitors, but it always seems like there's issues coming up every quarter with some of the competitors within the industry. How do you, I guess, avoid those things? And how do you address a lot of those things that comes into play?
Yeah. So I'd start by saying, this is a really difficult industry. It's not just a high growth, was a more high growth industry in a very, very regulated market. And it's not just regulated market. Every market is different, as we know, and we always hear on your shows. So that layer of complication is really, really hard. And then layer in all the other stuff around the disconnect between state and federal law and the banking challenges. This is a really, really tough industry to provide capital. So that's number one. Number two, when you're in the sale-leaseback business, get beyond cannabis and look at this industry. Almost every company, when you're making decisions that'll last for 15 to 20 years, you're never, and I rarely speak in absolutes, but you're never going to be perfect. There's always going to be some issues, and so you'll need to deal with it. And for us, it's the same 2 names in our portfolio that we've been talking about for 2 years. And so we talked about them in 23. We rectified the issues and came to resolutions in late 23. And then in 2024, both of those situations came back up again. And so, we feel, again, validated around our underwriting approach that we don't have more names. It's not to mean we're never going to have another issue in the future, but we feel good about where we sit today because of the decisions we made a few years ago and the deals we pursue, that EBITDA coverage, that's that cash flow at the property level, which we think is a key underwriting factor in protecting value for shareholders.
When you identify a deal and when you identify a tenant that, let's say, is worth investing in and worth doing business with, how much of the process is looking at their actual business plan on a go-forward basis and their expansion plans to be like, all right, well, we're comfortable with this person in this market. We want to grow with them and become a capital partner to the enterprise at large, not just like in a one-off deal basis.
Yeah, it's a really good question. It is.
Very good.
You're not surprised to hear me say it is extremely. I don't want to call it arduous. It's a very complete process. Let's utilize a deal we just did. We announced that we had done in the first quarter for Cresco. Now, Cresco has been a tenant of ours. We're very, very familiar with them. We understand their business plan, but it's not just about understanding the business plan for Cresco and doing that deal in the first quarter. It was about understanding the plan for that dispensary. It was a dispensary deal in Ohio. So it's understanding the state. What's the state going to evolve? Do we want to be in the state of Ohio? What about this particular dispensary? Where is it in Ohio? What does the competitive landscape look like? Where is it relative to surrounding states? What's happening regulatorily wise in those surrounding states? And not just what is the tenant's overall strategy, especially when they're multi-state operators, but what's their strategy in the state? How does this property fit the strategy in the state? And what's their strategy for this particular dispensary? So there are multiple layers that you have to peel back, particularly because this industry is so highly regulated. It's so different state from state. So we go through all of that, and then we look at the alternative use value of the property and lots of other things.
How are you preparing New York this year? Because we've seen some, a turnaround within the state, but is it still, I would still think proceed with caution, but you had to be disciplined, as you've evidently said. But is it a market that, you're looking at closely, knowing it's, hit the $1 million run rate last year, or $1 billion, excuse me. And you're starting to see a turnaround story within the state?
Yeah, it's becoming more attractive to invest into. I'm not going to say that as we sit here today, we're ready to jump into it. But when I look at the development of that state versus where it was 18 months ago, feel a lot better about where it is and where it's going, right? It's also about, the proverbial, where's the puck going? And so we always try to think about what does the future look like? Because again, very long duration leases, it's not so much about what is today's environment. It's really about what's it going to look like 2, 5, 10 years from now. And so as we look at that, I feel like the way the state is evolving, it's allowing us to have more, shall we say, certainty of what the outlook for the future looks like. And I'd say 18 months ago, it was really, really hard to figure out which direction the state was going to go. Was it going to get its proverbial what together, or is it going to continue to bump along the bottom of the ocean the way it was?
But do you see that there is a direction now?
I think there's a little bit more direction.
Just not there yet.
Yeah, it's just not there. I think it's a good wholesale market. They're opening all of these dispensaries.
Good point.
A lot of cultivation competition. So we think it should be a good wholesale market. For that reason, we'll watch the state continue to open more and more dispensaries. We know the state needs more dispensaries.
Yeah.
The issue we want to continue to see more progress on is shutting down the illegal shops. I mean, we've said it so many times. If an illegal liquor store opened up on a street, it would shut down within a day and wouldn't reopen the next week or the next month. So we just need some better enforcement.
Yeah, I hear you. Well, sorry, I don't know if you guys got glitched there for a second, but all in all, I have to hand it to you. Like I said, in a industry right now with a lot of headwinds, you continue. I think it's just about discipline, right? I know we just want to exploit, expand and provide capital in all these different markets. But the key right now is whatever decision that you make today, you can really see 2 to 3 years from now, correct?
Yeah, that's right. And as I said, sometimes it's easy to do the deals, but it's hard to collect the rent. So we need to make sure that these transactions are going to be there for us to be able to collect our rent and get the return for our investors that we need.
Yeah, great podcast last week with both you and Frank. We got a lot of great feedback, but I know there's been a few other companies that have reported since then. But all in all, how would you best categorize, I guess, this earnings season so far for the industry?
Yeah, I've really enjoyed that. And I think that there's a lot of great information. I think Frank is a terrific resource for the industry. Encourage everybody to follow him. I certainly do, and really appreciate his information. It sounded like an infomercial. I don't get paid for that promotion, but really, really enjoy Frank. So far, no surprises. Really, I haven't gone through everybody's. It's been busy. We had our earnings this week as well. So I've, next week and the week after will be where I really dig in. I think that the industry is going to struggle to get some growth here, some meaningful growth. But I think the industry continues to do what it does, which is be disciplined around expenses. I think we've seen people really bring in some of the expenses.
Definitely seeing that.
Right. I think people are having a no sacred cows type of approach to their business. I like the way people are trying to get ahead of the wall of maturities that occurs in 26 and then 27. I think that's smart. And it brings back to another theme, which is sometimes people look at these companies and they'll say, oh, they're dead in the water. And they forget these management teams are smart. They're dynamic. They have tools. They could sell off a state. They could sell off a property. There are tools at their disposal quite often that allow them to continue to extend the runway, to realize maximum value of their platform. Some companies end up not being able to make it, but I think it's important for people to remember that these companies are dynamic and they can react to the situation.
Yeah. We saw that yesterday in the earnings call with Ayr Wellness about the state of Illinois, but no longer going to be working within that state. But I think you'll see more and more of that as companies, like I said, start to get more strategic. And in a lot of ways, as Frank said last week regarding that announcement regarding the cannabis, live to fight another day and extend, obviously, that debt. But it's all based on execution. Saying all this, and I'll wrap up.
I heard Jim, just if I can, since I heard Jim's comments around the podcast we had around the taxes. And so I love that he referenced State House, because it's really, I think, a good illustration of how 2 points. Number one, you do have to pay back the taxes. So that is a liability. I agree it's not debt with a maturity date and a counterparty you have to negotiate to buy more time, but you will have to pay it back. The second point is when you look at State House, he's right. It was a deep discount, but that was specific for the situation. The IRS will not give a deep discount to a company that's doing really, really well. They're going to create a payment plan. But so I think it's a bit of a hybrid. I think we have to think about it as debt. And there may be the potential for some discounts, but those will only be derived at the time when you're negotiating with the IRS. And you can't say that because State House did 15, everyone's going to get 15. Someone that's killing it, if the environment changes and you're killing it and you're making money hand over the fist, you're going to have a difficult time getting a deep discount with the IRS. So probably some in the middle.
Completely agree. Where do you think is the biggest opportunity for you and your growth the rest of this year? Like, again, I know that's like, we got to be careful of how we're progressing with the industry right here. It's going to be all about discipline and execution, time and time again, that we've said. But hope, it's, I don't want to sit here and speculate in the event that reform changes and how that'll look, because we can't really focus on that at this particular point right now. But where is, the way things sit right now, the biggest growth opportunity for you? Because how you look at this in some ways indirectly gives people an idea on how you think the overall industry is going to mature and expand, or at least change over these next 9 months.
Yeah, and I've been accused in the last 24 hours since our earnings call of being maybe too negative on the industry. I don't mean to be too negative on the industry, but I want to bring a dose of reality to the conversation about it's a difficult market. You listen to those phone calls. I don't hear any operator CEOs declaring that this is going to be a phenomenal 2025. It's a difficult operating environment. We all have some hard work to do in 2025. Answer your question, where do we see growth? Kentucky's an obvious one. You have an entire cannabis market that has to get built out. So that's an obvious one. And we'll look to see if there's opportunities to partner with the right counterparty and the right property in that state. If Pennsylvania ends up approving rec, that could be a 26 opportunity. There is a lot of cultivation in the state already, but you could see maybe some expansion on the dispensary side. There's if you get Georgia to decide this year that they want to expand their marketplace, they have a very, very tiny market right now. There could be some opportunities for us there. So, we're looking at all of these markets, and then we're also looking at people who have upcoming maturities. Some of them, I'd say often, they have properties that are part of the collateral profile with their lenders. And I always like to have conversations with them about, look at the advance rate you're getting from your lender versus the advance rate you could get in a sale-leaseback transaction. And I think there could be the opportunity for some folks to break off some of that collateral, sale-leaseback, it gets some extra proceeds, maybe even renegotiate that with a little bit of pay down of debt. But who knows if any of that will come to fruition. But those are the areas we look at.
Yeah. Well, like you said, maintain your dividend in an industry that saw a lot of volatility this year. And again, increased your revenue by 6%. So all in all, when you talk about discipline, the numbers don't lie, right?
Yeah. Listen, nobody's taking victory laps here.
No, I get it, but I think that's a huge win. I think right now in the industry.
No, listen, we feel really good. We feel really good. And again, for a shareholder basis, that AFFO per share was up 10% year over year. That's the type of stuff I focus on. What are we delivering for our shareholders? And our dividends since our IPO in 21 is up 80%.
80%.
So we're able to grow the dividend since 2021. We're able to grow our AFFO per share. And we're going to continue to have that type of shareholder focused approach as we move forward.
Awesome. Always good talking to you, my friend. Keep up the great work, and always enjoy your insight on the industry as a whole. But enjoy the rest of your day and weekend. And again, thanks for wishing Anthony all the best with his family there. I know that when my daughter was going through a couple of issues 3-4 months ago, that you were very nice to pull me aside and say, get out of here and families first. But not only a great CEO, but just a good quality person. And I appreciate obviously everything you do for us. Okay.
You're kind. Thanks for giving me the opportunity to talk about NewLake.
Yeah.
We'll talk soon.
Take care.
Take care.
All right. That's going to wrap things up. I think Anthony's dealing with some technical issues, but I did want to touch on what was everyone's thoughts on earnings. TerrAscend and Ayr Wellness yesterday. I know Ayr's latest results got some attention. They had a write down of $118 million, walking away from basically Illinois. And I know their CFO is moving on as well, but it'll be interesting to see how Ayr Wellness is going to perform in that upcoming debt due in December of 2026. Are you back? Can you hear me? Hello? I can see you. Cresco will be interesting next week. Yes, Mitch. We're going to reach out to Charlie and the crew and hopefully get him on. Yes, AC is a classed act. Wop, if you've got the link, feel free to log on too. I forgot to mention that to you today. I'm sure people like to see you on a Friday. But Anthony, can you hear me or no? No, you can't hear me. What else have we got here? Just want to quickly go over some of the numbers in case some of you missed it. So for TerrAscend, they reported 74.4 million, a slight increase from 74.2 million in Q3 of 2024. Gross profit margin expanded to 50.2%, was up from 48.8% in Q3 of 2024. Net loss, 30.2 million, including a 45.4 million non-cash impairment charge related to their Michigan business, and adjusted EBITDA of 15.1 million compared to 13.7 million of Q3 2024. Free cash flow, 5 million, up from 1.5 million in Q3 2024. That's an important stat, as Jason continues to understand in Ziad. Very lean machine and very laser focused. Like what they do there, and curious to see how this stock could actually move in the event we get reform, because I know it's one of those quote unquote tier 2 type companies, along with, for example, Jushi here this morning with Jim Cacioppo, a few others. And don't look now, but Verano, I was looking yesterday, $255 million market cap. This is close to $1 billion market cap at one time, and wasn't that long ago. It gives you a realization of where we are right now in the space. But listen, I want to wish everybody a great rest of your day. Enjoy the rest of your weekend. And we'll see you back here Monday at 4 o'clock. Got an action-packed show next week. We're actually bringing on former NBA basketball player Al Harrington from Viola Brands. He's going to be actually coming on early next week. We'll have that podcast set up for you next week, probably next Wednesday or Thursday. It's going to be a pre-record, so we'll have that out probably by next Thursday. Big Mike is coming on as well. And then we got a few earnings reports again next week that we'll be covering, getting a full recap and analysis on really how we should view this earnings season as a whole over these last couple of weeks. I think Mr. Varrell is coming on. Regardless, I think we got everything covered here today. I hope you got some great feedback from both Jim and Anthony. And like I said, scan that QR code, get our full analysis of the earnings season and what we think of how it's performed so far and what you should know moving forward. In the meantime, like I said, enjoy the rest of your day. See you back here Monday at 4 o'clock. Thanks, everyone. Hey, everybody. Stay connected here. The latest Traded Black podcast. Another great episode under the belt. What'd y'all think? Do you like what we had to say? Please leave any comments below. And as usual, make sure to subscribe to our baked-in newsletter. Check us out on Apple and Spotify. And if you haven't done so already, make sure to smash that like button, leave some comments, as I said before, and subscribe to our channel because we wouldn't be here without you. Thanks again, everybody, for watching.